Hello and welcome back. Today we are going to take a look at the JEPY ETF, which is the S&P 500 Enhanced Option Income ETF offered by Defiance. As you can see, it has a very high distribution rate, 55% as of making this video, and it is a sister ETF of QQQY, which also has a very high distribution rate of 67%. I already reviewed QQQY, so if you haven't checked out that video, I highly recommend you do. But in this video, we will be taking a look at JEPY. And in the first half, we will discuss how this ETF works. And in the second half, we will take a look at how this ETF fits into a portfolio where you're not taking too much risk. So I will discuss a few strategies on how you can make it a part of your portfolio where you can receive the income, but at the same time, you are somewhat reducing the downside of a capital erosion, which is something quite common among these option income ETFs. So let's get started. So the income generation strategy used by this ETF is explained on their website. As we can see on the screen, they use a put right strategy to generate income, and they do it quite smartly by using the zero day to expiries or zero DTE options, which is basically options that are written on a daily basis and expire within a day. Now, those of you who are not familiar with put right, in case you're not familiar with options in general, I would highly recommend that you do check out some basic tutorial videos. There are lots of them on YouTube that explain how the options work, option strategy works. But put right is basically an inverse of the covered call option writing strategy. In case of covered call, you need to have a collateral of 100 shares on which you write the call option and sell it in the market and collect premium. With put right, you maintain a certain cash balance to cover your position in case things do not go as planned. And then you write the option on that cash balance and sell it in the market and collect premium. So, very similar to covered call, just an inverse version of it. But the really unique aspect of this ETF is the 0 days to expiry. This option of writing contracts that expire within a day was actually not available to us until very recently. This is what makes this ETF stand out from all other income generating ETFs. So I in fact found an article on Nasdaq website. I've put the link in the description. So here we actually see the history of the 0 day to expiry options. So it was originally introduced in 2005, but at the time the trading was allowed only for one day in a week. So you can write a 0 day to expiry option once a week, and that's it. You cannot write any more for the remaining week. Shortly after that, they made it possible to write it on Mondays and Wednesdays. But again, we are still limited to 2 days in a week. So only in 2022, they allowed the 0 day to expiry options to be written on all 5 trading days, but they have still limited it to indexes. So mainly the S&P 500, and I think now they also added the Nasdaq 100 index, which is why we have the other QQQY ETF. So when you really think about it, this ETF would not have been possible until 2022 or prior to 2022, because before 2022 it was simply not possible to write these options on a daily basis. So this is a very new development, and that is why we have this high income option available now. Now, you are probably wondering why a 0 day to expiry option is better than an option that expires within a week, or maybe even one that expires within a month. Well, it has got something to do with the manner in which options risk is calculated. And I had explained this in my review of QQQY ETF as well. But in this video, I just want to explain it in a greater detail so you understand why this ETF is aiming for these 0 days to expiry options and how it gives them an advantage over other similar ETFs like QILD, which are also writing options to generate income, but they're clearly not generating the same amount of income. So, when it comes to options, there are overall five risk factors, as you can see on the screen: delta, gamma, theta, vega, and rho. Among these five risk factors, the one we are interested is in theta. You can pause the video to read the definitions for all the factors, but I'm going to quickly jump to the one that is most relevant to this ETF. So, theta is a risk factor that relates to the time value of an options contract. Unlike stocks, option contracts have an expiration date, and as the expiration date approaches, the value of the option keeps decreasing. The closer an option is to the expiration date, the lower is its value. And this works particularly great for someone who is selling an option. So, when you sell an option that is about to expire, you are really capturing a good amount of profit just by the time decay of that option. And this is where our zero date to expiration options within the JEPY ETF are so good compared to other similar covered call or put right options that operate on a monthly or weekly basis. Because these options expire within a day, it means that they are going to lose their value only within a few hours of being traded. What this means is that as investors, we are able to retain a large chunk of the profit from the options premium that we get from the trade. And this process gets repeated every trading day within the month. That is the reason why they are able to pay out such a high distribution rate as compared to a QYLD, which also uses options trading but is paying out around 12%. Now, you might be thinking all of this sounds great, but what is the catch in this? Well, the only catch or problem that I see with a zero day to expiry option is the fact that it could turn out to be a really bad trade if the underlying index, in this case the S&P 500, drops by a big margin on a particular day. And in general, it can go up or down from anywhere between 1 to 2%, which is okay. But let's say, what if it falls by 10% or 20%? And maybe you're wondering, has it ever really happened? Well, actually, it has happened. Here we see the largest single day drop that happened in the S&P 500 index. On October 19th, 1987, it fell by a little over 20% in a single day. Imagine if such a drop were to happen today. Uh, I mean, for the overall market, it would be pretty bad, but especially for an ETF like JEPY, I think it could probably wipe out the entire portfolio. As I said, 1 to 2% is okay, but any big move, anything over 10%, and certainly anything over 20%, would most likely wipe out the entire portfolio. So that's the risk we are taking on when investing in these ETFs, especially these zero day to expiry ETFs like JEPY and QQQY. And I'm not trying to scare you, but it is important to be aware of the worst case scenario whenever you are investing in the stock market. Having said that, I also want to stress that the probability of something like this happening is very, very low. In fact, if we take a look at this table, which shows the top 10 largest single day drops in the S&P 500 index, we see that 3 out of the top 5 worst days occurred in the year 1929, which was mainly due to the Great Depression. And there are a couple from 2020, which was mainly due to COVID. And the one at the top from 1987 was just a freak market correction that surprised everyone. and it is the only one with more than 20% drop. The point I'm trying to make again is that such drops are very rare in history, and they have mainly occurred during major global events like a war or a pandemic. But nonetheless, it is important to be aware of what could happen to this ETF in such scenarios. And that brings us to the second part of this video, where I will be discussing three strategies on how you can make this ETF a part of your portfolio, whereby you are getting the benefit from the income that we get from this ETF, but at the same time, we are minimizing the risk associated with it. And these strategies are applicable to both JEPY and QQQY ETFs. At the same time, they do not count as financial advice. I'm not a financial advisor. I'm simply sharing my views on the best way to invest in this ETF. All right, with that said, let us discuss the very first strategy. And this is probably the simplest and the most straightforward option, which I like to call the 5% rule. In this option, we simply make this ETF 5% of our total portfolio. Given its high distribution rate of 55%, it would help raise the overall yield for the total portfolio by around 2 to 3%. We can check this with a simple calculation. Let's say you have $10,000 to invest, and you're investing only 5% of that into this ETF. So that's 500. But for that 500, you're receiving a 55% income over the year. So you're receiving $275 over the year, which when you divide by your total portfolio value is 2.75%. So even at 5%, it is raising the overall yield of your portfolio by 2.75%. So if the remaining 95% of your portfolio, let's say, is giving out a yield of 5%, when you add this 2.75, you're almost raising it to around almost 8%. So with this 5% rule, you're really using this ETF as a way to boost the overall yield of your portfolio, but at the same time, keeping the risk of this ETF to a minimum. Even in the worst case scenario, you would lose about 5% of your portfolio. The second strategy is what I like to call index reallocation. Here I'm assuming that you already hold an ETF that follows the S&P 500 index. For example, the SPY ETF. Let's say if you are holding SPY ETF, what you could do is you could sell a certain percentage of that holding, say about 10%, and reallocate those funds to the JEPY ETF. Now, from the 10% holdings in JEPY, you're receiving 55% income, but for the remaining 90%, you're still able to get the capital gains. When you do the math, you will find that you're able to boost your income from your S&P 500 holdings by about 5.5%. And we can check that through a quick calculation over here. So let's say again you're holding $10,000 in the SPY ETF, and you sell 10% of that, which is 1,000, and you reallocate these funds to the JEPY ETF, and JEPY pays you 55% dividend or distribution over the year, which is $550, which when divided by your total holdings of SPY and JEPY combined results in a 5.5% income. Remember, both SPY and JEPY are based on the S&P 500 index. So the risk profile as far as the underlying holding is concerned is very same, is in fact exactly the same. The only difference is that JEPY has the additional risk of the options play, but that is useful for generating the additional income as well. The third and final strategy is actually a variation of the strategy we just discussed, and I would like to call it the aggressive index reallocation strategy. Here we do the same thing as we did in the previous strategy. We take $1,000 from the SPY investment and reinvest it in JEPY. But in addition to that, we again take another $1,000 from the SPY, and this time we reinvest it in a leveraged ETF called UPRO. In case you're not familiar with UPRO, it is a leveraged ETF that gives you a 2x return on the S&P 500 index. So if on a given day the S&P 500 index goes up by 1%, the UPRO ETF will give you a return of 2%. In fact, if we do a quick comparison for the year to date return, we find that the SPY ETF, which simply tracks the S&P 500 index, has returned 10% for the year so far. On the other hand, the UPRO, which tracks a 2x return for the S&P 500 index, has returned 20% for the year so far. So, in our hypothetical example, where we want to invest $10,000 in the S&P 500 index, this is how things would play out. You have $8,000 invested in the SPY ETF, nothing wrong with that, but $1,000 in the leveraged UPRO ETF are giving you an additional upside of $2,000. So you're really able to capture an upside of $10,000 on that total $9,000 investment. But then you have $1,000 left over, which you are investing in JEPY and receiving 55% income on that $1,000, which is equal to 5.5% income on the overall $10,000 holding. This is different from what we did in the previous strategy, where we are investing $9,000 in the SPY and $1,000 in JP, and we are giving up 10% of the upside in order to receive that additional 5.5% income on the overall $10,000 investment. So using UPRO is simply a way to recapture that 10% upside which we would have otherwise lost. And that brings us to the end of this video. As a closing thought, I would just like to reiterate that all the strategies I discussed are applicable to both JEPY and QQQY. You can also play around with the percentage allocations based on how much you feel comfortable with. And for QQQY, just substitute the SPY ETF with the QQQ ETF. And for the leveraged option, you can use QLD, which is a 2x version of the Nasdaq 100 index. And once again, these are just my opinions, not an investment advice. I'm not an investment advisor. So I hope you found some value in today's video. If you did, don't forget to like, share, and subscribe. I'll see you guys in the next one. Thanks for watching.